that's the image that our company uses a lot. It's a bit of an aspirational image. Maybe you're all dreaming about heading off in the sailing boat, and we like to make sure that your investments enable you to do these types of activities sooner rather than later. Yeah, I've been working in the industry now for about 24 years. Lived up in Queensland for 6 of those years here in Brisbane. Married a Queensland girl, but currently live in Sydney, much to her displeasure. So ultimately we'll get back here, but I do feel quite an affiliation with Queensland and Queenslanders as well. So thank you very much for coming today to hear us talk about and give you a little bit of an update on what's happening in the markets. Today I'm going to talk about some big picture themes. We call them macro themes. And I'm going to start with just a little bit of an update on what's been happening in markets, show you some performance chart of the key strategies and asset classes that we at Quilla look at when we're constructing portfolios. And then we'll get into the deep dive stuff, some heavy duty macroeconomic analysis. I won't bore you for too long, and we'll finish off with some valuation stuff, looking at whether markets are cheap or not after the recent falls, and then just a quick history lesson looking at historical bull and bear markets and how long they last, the magnitude of the falls, all the gains as well. So I'm going to try and finish on a slightly optimistic note. It's a bit difficult with the markets and the conditions that we find ourselves in, but hopefully I hand you on to the next speaker in a good mood. So this is the first chart we thought we'd start with. It's just a bit of a snapshot of what's been happening in markets this calendar year. Normally this chart has some red lines and some green and blue lines. Unfortunately, there's a little green or a little blue one right down here in the corner here, unfortunately. So some pretty hefty falls across the broad spectrum of markets. And we've grouped them into equity markets here. So you've got the US market at the very top here, the Australian market down 10%, Australian small cap market down 24%, and then this is a global index comprised of all the major developed economies down 25%. And then we've got emerging economies, which includes China, strangely, but down 26.89%. And then we've got these mix of asset classes here. These are all traditional defensive investments, so bonds, fixed income, corporate bonds, high yield bonds. This bunch here, and you can see even these ones have been red, but these ones traditionally we would expect to be green when these ones are red. So they've got some good diversification benefits historically, but even fixed income over the last 10 or so, 9 or 10 months has experienced some fairly significant declines, as well as bond yields have pushed up quite dramatically. And just to put that in perspective, the performance of these fixed income markets, these defensive asset classes, which are down 13%, down 10%, this is the worst market they've experienced in over 30 years. So it's the worst time to be holding these types of strategies. So that's been a real challenge when you construct portfolios, is how do we achieve a reasonable outcome when that's the environment we're playing in. Down the bottom here you've got a couple of domestic REITs, which is real estate investment trusts. Things like what's the new name of that company? It's not Westfield anymore. Centre type companies, and then you've got your global REITs. So these could be diversified shopping centres, they could be diversified residential trusts that hold assets. So these two asset classes take the gold medal as the two worst performers over the calendar year, down 31% and 28% respectively for those at the back. So why have REITs? Why have property assets been the worst performers? Well, when you look within the property sector, it's comprised of a number of different areas. As I mentioned, residential REITs or residential assets, so assets tied to the residential property market. could be industrial property as well, could be commercial property. So there's a number of different elements to this market. The worst part of this sector has been residential property. So it's fallen quite significantly as mortgage rates have increased over the last 9 or 10 months. So this sector tends to be a bit more sensitive to rising interest rates because it has higher debt levels than the rest of the equity market. So higher debt levels means higher interest costs. So as interest rates are rising, your interest costs are also rising, meaning you get an impact to the profitability of those companies. So it hasn't been the place to be, and I'm pleased to say we don't directly hold any of these types of assets in the portfolios that you may actually be invested in. Down the bottom here, we've got some other less well-known investments, but you've got gold down here at the third from the bottom or fourth from the bottom, down 8%. Gold is typically a relatively defensive investment as well. It's where people go to preserve capital when things are going pear-shaped in other parts of the market, when geopolitical risks are higher, for instance, or to protect against higher inflation. And to some extent it has done that. It's only down 8%, but I only say only down 8%. And that's not too bad when you look at the bigger picture here, where you've got negative 31%, negative 26%. So it's held its value a little better than some of those other asset classes, but still not a particularly good place to invest over the last 9 months either. Iron ore, traditionally being one of the mainstays of the Australian export economy, has fallen quite significantly as well, down 20%. Iron ore is largely being driven in Australia by our exports to China, so Chinese demand, building infrastructure projects. The Chinese economy has experienced a fairly rapid decline, particularly in the last 4 or 5 months of this year, off the back of a collapse in their property sector, combined with already very high debt levels at the local government level. And we're seeing a real reluctance by the Chinese policymakers to stimulate their economy like they have in previous downturns. So we're quite concerned actually about the Chinese economy more generally because of this lack of policy stimulus and because of this major problem they've got in their property sector. So we don't hold that. We've actually removed that from the portfolios. And I think it also presents a fairly negative outlook for iron ore over the coming quarters and year as well. Down at the very bottom, or the second from the bottom, you've got the Australian dollar against the US dollar. And then at the very bottom, we've got this trade weighted index. So that's a basket of currency. So that's showing you the performance of our currency against not just the US dollar, but a basket of our major trading partners. And that's the only good one. It's the only one where we've done positive 0.65%. Nothing to write home about, but you can see we've depreciated against the US dollar by about 11%. That's actually pretty good. When you look at the performance of the US dollar over the space of this year, to have our currency only fall by about 11%, it has actually been one of the best performing currencies, which is a little bit strange when you look at things like iron ore, which is our major commodity export, down 20%. You'd go, well, if our major commodity export is down 20%, how is our currency doing reasonably well against the US dollar? And it's really associated with other export markets that Australia is now starting to dominate in, mainly thermal coal. So that's coal used in the electricity generation process. And you may know, as a result of the conflict in the Ukraine, there's been a rotation back to more traditional coal-fired electricity power stations because of the very high cost of LNG or gas off the back of the restrictions that Russia are imposing on the rest of the world. So that's really holding up our currency, and I think it will continue to provide a floor under our currency. I don't think our currency is going to fall back to those levels of 40s or 50s that you guys may remember, which were back in the late 80s and early 90s. But yeah, look, it's hard to put a positive spin on that. But the one thing I can say and this is an optimist in me speaking, is valuations are looking cheap. They've fallen. We've borne the hard yards so far, and you would say that they're certainly cheaper than what they were in January of this year. But the key question is, and one that I hope to give you a little bit more information on today, is does that mean it's time to step back into the markets? Are we likely to see some sort of rebound after these fairly significant falls? All right. This next one, it's a bit messy and it's probably a bit hard to follow with all those colours, but I thought we'd just step into a bit of a summary of the global economy. And this table, whilst it provides a lot of information, does break it up quite nicely, and I'll just highlight a couple of things to draw out some points. Because if you look at those market performance numbers that I just showed you, you think, well, the global economy is collapsing, everything's tracking pretty poorly, earnings are struggling, but it's actually not the case. And this is the strange thing. At the moment, we've got countries like the United States, for instance, that have got relatively good indicators. This is a manufacturing PMI. This is an index that we track, which is a good leading indicator for the relative strength of that economy. And the way to understand this index is any number here below 50 is an indication that that economy is struggling. It's actually contracting, or the manufacturing sector is contracting. Any number above 50 indicates that that economy is actually doing reasonably well. So you can see here, United States, 51.5, their manufacturing sector is doing pretty well. Australia down here, 53.8, an indication that perhaps our economy is tracking reasonably well. And then if you move across to another one over here, I've just picked retail trade, for instance. You can see 10.1% growth year on year in the US, 16.5% retail trade growth here in Australia. So those two countries are the best performers out of that group in that indicator. So you look at that and you say, well, that's a little odd. Our market is our market's fallen 10% or 24% depending on the index you look at. The US market's down 23%, yet these headline indicators suggesting their economy is actually pretty strong. Something strange is happening. On the flip side, you do have countries that are actually performing pretty poorly and are likely to continue that, the Eurozone. Understandably, their manufacturing sector is contracting. They're below 50. Their retail trade numbers are pretty low as well, negative 3.3%. United Kingdom, 47. Retail trade, negative 3.3. So a couple of the countries there, China down the bottom here, I picked on GDP growth because they're the worst out of this bunch. That's their aggregate growth over the year, 0.4%. Now that's very low for China, who are traditionally used to producing numbers like 5, 6 or 7%. So to produce a number close to zero indicates that their economy really is struggling. And their manufacturing PMI below 50 indicates that as well. So it's a mixed bag. And I think that really does highlight perhaps some of the issues that we're a little bit concerned about right now. So even though we've seen those very big falls in markets that I just talked to you about, there's still potential for some of these markets that are holding up, or some of these economies that are holding up pretty well to fall. And we track the pace of change of these economies, and countries like Australia and the US, which have been tracking pretty well, are looking like they're going to be moving into some sort of recessionary environment later next year. And that gives us cause for additional concern. So I thought I'd just highlight a few points just to pick up on why some of those numbers have been really strong in the face of equity markets and fixed income markets, which have been falling pretty heavily. So this one is household savings rates here on your left. And it just tracks levels since 2019. So we get an indication of what was happening prior to the pandemic, what happened during the pandemic, and then what's happened post the pandemic. And you can see the trend here with savings levels is they weren't particularly strong prior to the pandemic. In fact, indications back here were that growth was actually starting to struggle. They peaked as stimulus checks in the US were mailed out, people banked their checks, they reduced their spending habits, and that's a natural behaviour in times of uncertainty as you perhaps rein in spending, build up your savings balances, and that's exactly what did happen. But you can see since then, it's been a downward trajectory pretty much consistently right through to now, where we actually have countries like the US, which is this red line here, at levels below where they were prior to the pandemic. So that's been really acting as a buffer. So we know we've seen central banks around the world increasing interest rates in an attempt to slow down retail spending and slow down their economies. But you've had this massive amount of savings flooding back into the market, and that's sustaining those strong retail and consumption numbers that we were just talking about. So that's flying against what central banks are trying to do. However, we have now reached the point where companies can no longer rely on consumers to keep spending savings because their savings are almost extinguished. And that is the concern that we have, and that is the concern that quite a number of companies in the US and here in Australia have flagged at their recent reporting season as well, is they are concerned about the demand side. They're not so much concerned about the cost side because most of them see cost moderating, but they see margin compression happening as a result of a reduction in demand or consumption. At the same time as this is happening over here. Now what this is showing you is employment. Now headline unemployment levels is a lagging indicator, so we don't look at that because it comes out after the fact. But this is a really interesting indicator that's published in the US, and it's called unemployment insurance claims. So this is what unemployed people do in the US. They apply for these insurance claims to help give them a salary whilst they're unemployed. And this is published weekly, so it's very timely data. Now we've just plotted it against a trend line here, which we established back in 1819, but you can basically see that the recent trend, just in the last 3 or 4 weeks, has seen an uptick in these unemployment insurance claims, indicating that more people are starting to file for unemployment benefits in the US. Now we're not going to see this type of trend or theme flow through into the headline unemployment number, probably for another 2 or 3 months at least. So this gives us a real feel for what's happening at the grassroots. What's happening with companies? Are they laying off workers? Are they seeing pressures? And that would suggest that consumption is pulling back, and at the same time companies are starting to lay off workers. Okay, now that information is probably not as widely known as what you might believe. So it does brings us some cause for concern about what may happen in the next reporting season in the US, which actually starts later this month. Let's talk about cash rates, because that's the other area, a big driver of market behaviour more recently. And you're all aware, obviously, we had the RBA report on give us a 25 basis point hike to our cash rate yesterday. What this chart is showing you is it's actually showing you what the market's expectations for our cash rate are. So this is derived from market expectations. So this is where it was prior to yesterday, 2.35%. The market had priced in that the rate by the middle of this month would be 2.69, 2.7% essentially. So they were pretty close. What did it go to? 2.6. So they were slightly above what actually happened, but that was the market's expectation. And you can see the markets expect the cash rate to keep on increasing to this peak here, which is May 2023, so May next year. They expect it to get to 4.1% and then just basically stay at those levels for the best part of, the length of this chart, taking us right out to early 2024. 4.1%. We're at 2.6. So we're talking another 1.5% in, what's that, 7-8 months. So that's pretty dire. There's no meeting in January. So, you know, when you think about that, you can understand the concern that we have if the RBA actually follows through on that pace of tightening. Now, I think just over the last 24 hours, we've probably seen a little bit of that expectation moderate a little bit. We actually believe that was a little too aggressive. I think markets might have actually got it a little bit wrong there. So we anticipate that the pace will increase, but the RBA may actually not continue to tighten right through to 4.1%. In the US, just as by point of comparison, the market's pricing for the US cash rate is about 4.3% by early next year. So once again, that's pretty heavy. And just to let you know, the US market is currently sitting at 3.25% in terms of their cash rate. So they've got another 100 basis points of tightening just in the next 3 or 4 months priced in as well. So investors hate this, particularly equity markets, because it makes the future value of their cash flows less valuable because this type of cash rate gets priced into the discount. So that's why you see equity markets sell off when there's any thought of interest rates going up faster than what they expect. Anyway, interesting that. I think if we do see a more moderate pace of tightening, then it'll actually be received relatively positively by markets. And that's why we saw equity markets rally yesterday. Some banks have been expecting a 50 basis point increase. We only got 25. So markets actually like that. They like that slightly more moderate pace of growth. So if what we think comes to fruition, then perhaps markets might be a little bit more accommodative if this is slightly less aggressive than what's currently shown on the chart here. So that's not a bad story. But then we have this concern about recession. So central banks, our own RBA, the Fed in the US, the Bank of England in the UK, they're all trying to manage this situation where they slow their economies, but they don't push them into a very deep recession. So we've been tracking a number of indicators just so we can get a feel for what the likelihood of this recession is. And these have historically proved to be very reliable indicators, to the point where if you get all these indicators with a yes in this column, it's highly likely, very high probability, that you're going to have a recession at some point in the future, probably 6 months in the future. Now you can see here, we've got a few yeses already. We've got an inverted yield curve. What that means is the short end of the yield curve, so the 2-year end of the yield curve, it has a higher interest rate than the long end of the yield curve, the 10-year point. So it's inverted, which means that's an indication of a future recession. And that indicator by itself has got almost a perfect record of forecasting future recessions. And it's yes, so it's met, tick. Rising credit spreads. So this is the premium that fixed income investors charge to buy credit securities issued by companies. When they tend to increase, that means there's more risk on the horizon. That's been happening already. Tick. Federal funds rate above neutral. Well, as I mentioned, that the US federal funds rate is the US cash rate. So I mentioned the US cash rate is currently, what did I say, 3.25%. It's currently predicted to go to 4.3% by early next year. The neutral rate for the US market is about 3.9%. Now, what the neutral rate means is that's the point at which monetary policy or the cash rate is neither accommodative for markets, so it's not acting as a stimulant to markets, or it's neither acting as a negative influence on markets. So by nature of the name, it's neutral. So we're getting close to that point. If neutral's 3.9% in the US, and the current cash rate is 3.25, we're only one hike away from getting back to that point of neutrality. And I anticipate it's probably going to go above that by early next year as well. So that one, whilst not met currently, probably will be fairly soon. Global PMIs. Well, we looked at those earlier, and you saw that some countries were below 50, some countries were still above 50. We've been watching the pace of change of those countries like Australia and the US, which were still sitting at reasonable levels. They are falling. So we anticipate that even Australia and the US will likely fall below 50 sometime in the next 6 months or so. So that'll move to yes. So we've got yes, yes, yes soon, yes soon. Declining cyclical spending, we track that as well. It's an indication of the amount of stimulus. It's partially there already. Peak in profit margins, look to have done that already. Jobless claims, that previous chart that we just looked at, well, we noticed they've recently begun increasing as well. So this is not a particularly good story. It's highlighting that there is likely a recession on the horizon. So the big question now is, how deep is that recession going to be? And at what point have markets already priced that in? Because that's the key thing. Markets usually price in things like recessions ahead of time. So by the time the recession is over, markets have actually started recovering. So we can't wait for the recession indicators. We can't wait for the bottom of the recession before we start taking risk back on in portfolios. We've got to be a bit run ahead of that a little bit. So for us, it's important to understand the timing around that. I've got probably only a couple more minutes, so I just want to touch on a couple of slides here. These actually this one's a quick one. I just wanted to put in a residential housing. This is always an interesting one. We've all mostly got property, residential property. We live in one or we invest in them. So this just tracks some interesting indicators here in Australia. So we've got Australia, the dark line here, and then we've got Sweden, Canada. And this is residential investment. Anything below this line would suggest that perhaps there's been a level of overbuilding over the last, 20 years. So Australia is in that mark. It's been a high level of building. This is price increases. So Australia, Canada, US, UK, Sweden, Germany, Japan, New Zealand. The strongest price increases have been Australia, New Zealand, Sweden and Canada. So these ones here. The ones that are sitting at the bottom there, interestingly, US, is third from the bottom. It's not particularly strong. Japan, we know their economy's been relatively benign for many, many years now, so that doesn't really surprise. So price levels are high compared to a lot of other countries. There's been oversupply. And on the right, debt levels. Australia is part of this grouping here, which is those average of New Zealand, Canada, Australia and Sweden. Our debt levels are a lot higher than other countries, significantly higher. So you put all that together, it doesn't paint a particularly rosy picture, especially when you've got central banks and the RBA tightening, increasing monetary policy. They're aware of that, by the way. The RBA are certainly aware of this dynamic, which is why they're taking a more moderate pace to their tightening compared to the US. So this is the US here. Which one is US? The brown one. So their debt levels are significantly lower. So essentially what it means is our RBA is a little bit constrained by that. If they tighten too hard and too fast, they'll effectively cause a massive crash in our property sector because of the excessive debt we've got there relative to countries like the US. So they've got to be very mindful of that dynamic. Quick chart on valuations. With all those collapses and those falls that we talked about at the very start, you would think that perhaps valuations were looking quite cheap. Hopefully I've just given you some further information that would suggest that perhaps there's still some risks on the horizon and we need to just be a little bit mindful. But when we look at an indicator like a price to earnings ratio, this is a PE ratio, you've probably heard of this indicator. And what we've done here is plot the PE ratio for each of these. So that's the US, the global aggregate, Australia, Europe, Japan and emerging markets. And these bars here just represent effectively the historical range for the PE over recent periods. So black's the middle of the range, that's at the bottom of the range, that's the high end of the range. You can see they're all sitting, they're neither really cheap nor are they really expensive. So they're all sort of sitting about the middle. So that's with those big price falls factored in as well. So PEs are not suggesting that markets are a raging hot buy right now. And I think some of the macro indicators that we're watching would also suggest that there's possibly some further pain on the horizon. We might see a very short-term rally, don't get me wrong. And we've seen 4 bear market rallies this year of varying magnitudes. It might be 7, 15%. So I fully expect there might be a little bit of a rally. We've already seen one over the last couple of days, but don't be fooled into thinking that's the start of a massive rebound. These rallies are designed to catch the unwary, and they catch a lot of people, but I think you need to be mindful that there may actually be another pullback in this market from here. And talking about bulls and bear markets, I thought I'd just finish on this slide. This is the optimistic slide that I said I'd finish with. This is just a quick summary of bull years and bear years, and it just highlights to you how long these bulls and bears went for, and how much the market gained during that market. So you can see here, above the line, the green section obviously is the bull years. So these are when the market's rising. We get long periods of very steady, effectively very steady growth. Very long periods. 5 years here, a 19-year bull year here where the market, bull run here where the market went up 1,200%. Followed by a very short bear market of 1.3 years where it went down 48%. But you know what, if it's just gone up 1,200%, a 48% decline is not going to break the bank unless you invested right here. Then we had another very strong run of 11 years, 342% gain, followed by a short pullback here, which was the pandemic, incidentally. And then we've obviously had a fairly good run since the pandemic as well. So the point here is, on average, bear markets last for only just under 1 year. So they're relatively short in nature. But the bull markets last for a lot longer, 7.8 years on average. So you might say, with all this bad news, why are we still invested? Well, we recognise that the best way to make money for you guys over the long term is actually to remain invested. We can do our best to try and mitigate the impacts of these drawdowns when they occur, but we want to be making sure that we remain invested so that we capture these upsides ultimately when the market does bottom out. So that's the good news. Any questions, guys? I'm conscious of the time. I know there's another speaker here, but we can probably do a very quick question if anyone's got one. Or we can save them to the end. Yeah, I think we'll save them to the end.
Oh, no, we'll go.
Yeah?
Andrew, if you had to pick one asset class to invest in now for the next couple of years, what would it be?
Oh, thanks for the forewarning on that one.
I know you love that question.
I think fixed income markets are increasingly looking like they're better value now. You saw the returns of those more defensive investments that I showed you at the very start. Bond yields have been rising. As I said, the cash rate in the US is 3.2%. Here in Australia, we're now at 2.6%. That means you're going to get a reasonable yield on some of these more defensive investments, which over the last 2 or 3 years, how much yield have they been paying? Zip, nothing. So that's going to insulate you against any sort of volatility. So I think some defensive investments are actually coming back in favour, and I would put term deposits back in that basket as well. We can hold cash and defensive investments in the portfolio, so we're mindful of that, and we're starting to gradually dial back into those types of markets that pay a reasonable yield. So I'd say that one, Scott, but I'd also say some alternative asset classes as well, where these are things that are not as easily defined as just shares or bonds. They tend to be a bit more active. There's more manager skill involved in them. But they tend to provide, or the aim of them is to provide diversification in a portfolio. So when equity markets are not performing well, these alternative investments might do a little bit better. And they capture a whole range of things. They might be commodities or timber assets or agricultural assets. You can put in there hedge funds as well, something that we haven't used a lot of in the past, private equity. So a lot of those types of things. Not private equity, actually, they get captured, but that's not part of the recommendations I'll be making, but some of those other things are quite good. Well, hopefully you've given something to think about tonight as you're dozing off in bed, but thank you very much for your time.
Thanks, Andrew. Our next speaker is Tom King. Tom King is the fund manager for Nanook New World Fund. Now, Nanook is in a lot of client portfolios.
That's the card.
So if you're looking at your statement, you might see Nanook in there. So we thought it'd be relevant to have Tom come in. Now, Tom joined Nanook in 2009. He's a director of the firm, the firm's chief investment officer, one of the firm's portfolio managers with over 20 years' experience. Tom holds a first-class honours degree in engineering from the University of Melbourne. Tom also won gold in the 470 sailing class at the 2000 Sydney Olympics and is a prominent member of the Australian Olympic Committee. Tom also received the Medal of the Order of Australia. So please welcome Tom King.
Thanks for the opportunity to come and talk today. I've got a slide deck here that has far too much to go through in 20 or 30 minutes, so I'll jump through it quite quickly. But what I really wanted to do was talk a little bit about who we are and what we do, but perhaps more importantly, why we do what we do, and give you some of our thoughts about where the world is heading and what that means from an investment perspective. And then talk about some of the areas where we see opportunities are investing today within the fund and looking at in terms of prospective investments going forward. And I'll also sort of touch on markets and performance. Obviously, Andrew's given a fairly comprehensive overview of what's been going on. It's obviously been a very difficult time for investing in just about any asset class, and that's certainly true of the area that we're focused on. But as Andrew pointed out, what that portends is a period where prospective returns look much better than they did a few months ago. So Nanook Asset Management's an Australian-based funds management business. We started nearly 13 years ago now and have staff up here in Brisbane. So there's two of us based in Brisbane, but also in Sydney, Melbourne and London. And as a firm, our focus is on sustainability and specifically understanding the investment implications of environmental sustainability and resource efficiency. And the fund that we run, the Nanook New World Fund, is a global equity fund. In most respects, a pretty simple and vanilla proposition as an investment fund. It holds a diversified set of stocks globally. It is fully invested in the market on a continual basis, so it'll go up and down with equity markets generally, and it's unhedged, so it's invested in foreign markets, in foreign currencies, and so it's exposed not just to market movements but to the movements in the Australian dollar, and it sits within people's portfolios to provide equity market exposure as part of global equity allocations, and our goal as a manager is to deliver performance from the fund over time that's better than the benchmarks that Andrew was pointing to, so better over the long run than an index like the MSCI World or MSCI All Country World Index. What differentiates what we do is we focus on a part of the market that we think is benefiting from or contributing to improving global environmental sustainability and resource efficiency. And that falls into 9 broad buckets, 9 broad thematic areas, most of which are fairly obvious if you start talking about environmental sustainability and resource efficiency. And it certainly includes some of the more prominent areas of sustainable technology like renewables and batteries and electric vehicles, but actually a quite broad range of different environmental and sustainable solutions, including a whole bunch of them that are pretty benign and boring, things like waste management and recycling. And that gives us the opportunity to put together a pretty well-diversified portfolio. We do that with a fairly conventional investment approach. At the end of the day, we're trying to buy what we think are good quality businesses that generate or can generate good returns on capital and are likely to benefit from not just the longer term sustainability transition, but also the nuanced and changing dynamics within the industries that they're operating. And at the end of the day, we try and find companies like that are trading at prices that we think are attractive relative to what they're likely to be worth in the future and therefore have the potential to generate returns that are better than the market. The whole process starts with trying to identify those types of companies. So we look for companies with a material level of involvement in the thematic areas we're focused on, but we also exclude companies that are engaged in activities that aren't well aligned with our mandate. Areas that are ethically contentious, things like alcohol, gaming and tobacco, which generally speaking don't fall within that set of thematic areas of focus anyway, and companies that are egregious sort of bad behaviours in terms of corporate governance. And that leaves us with an opportunity set of about 1,500 stocks globally that now represent somewhere between 15 and 20% of total global equity. So it's a big and interesting opportunity set. And we put together a portfolio that has somewhere between 60 and 70 stocks in it and provides exposure across the full range of thematic areas that we focus on. I run a team of 5 of us, all experienced global equity portfolio managers who are each responsible for picking stocks from that universe that we think are good ideas, and those come together in the fund's portfolio. And as you can see from the slide here, that results in a fairly diversified portfolio of companies that are mostly sort of unlikely to appear in other portfolios or be investments that you hold otherwise, which generally speaking should do good things to your overall portfolio. The exposure in the different areas we focus on changes over time as we see opportunities emerging and prices in different parts of the market becoming more or less attractive. At the moment, we have exposures in larger exposures in a number of areas that are lower growth in nature and perhaps a little more defensive in terms of their characteristics. So the areas with higher degrees of earnings certainty in an economic environment that is potentially weakening, things like businesses undertaking information services and analytics, data analytics for business, things like recyclable and sustainable packaging, which is largely focused on consumer staple end markets that are likely to be relatively stable in a recessionary environment, rail transport, which is a utility style business, and a number of areas of things like healthcare, technology. At the moment, we don't have a lot of exposure in areas like renewable energy, some of the higher growth areas, and that's because over the last couple of years, those parts of our opportunity set have been relatively expensive, and I'll talk a little bit about that in a minute. At a fund level, we're invested globally. The majority of the funds in North America, but we do have a significant amount of exposure in Western Europe and Asia. Most of that's in Japan. We hold a couple of companies in Taiwan and Korea. And the fund invests in some large companies. We have small holdings in Microsoft and Amazon, but it does invest in smaller companies. And our real niche is in sort of mid-sized businesses, mature, profitable companies, maybe between $5 and $15 billion of market capitalisation, that are specialised or have significant degrees of exposure in the areas that we're interested in. And the chart on the right shows that we are predominantly investing in applied industrial technologies, and our portfolio reflects that. So we don't have any oil and gas exposure, we don't have exposure to many consumer products, conventional healthcare like hospitals and pharmaceuticals, and not much exposure to the mining industry, and certainly not in financials and banks. That might change over time if we see more green banks emerging globally, but at this stage that hasn't happened. And the reason I showed that ties back to what Andrew was saying earlier. And I'll talk to our performance in a minute, we've not had a great year this year, largely courtesy of the way in which global equity markets have performed, and particularly the parts of the market that we're investing in. But you do get this diversification benefit. So to the extent that we're not investing in some of the areas that have performed well, like energy and financials, consumer products and healthcare, it's very likely that you've got quite significant exposures to those through Australian equities within your broader portfolios, and that tends to balance itself out over time. Yeah, if diversification works well, you'll get sort of equivalent returns with less volatility over time if you can find those kind of balances. So this year, and this is a somewhat confusing chart, we've seen global equity markets underperform. The dark line in the middle of the coloured stripe there, the rainbow, is the MSCI World Index. Higher growth stocks, shown in the red line, have quite significantly underperformed lower growth or value type stocks this year. And some of the areas of technology within the broader market, like semiconductors, have significantly underperformed. On the flip side, you've seen energy stocks, so oil and gas stocks, which obviously aren't part of our mandate, perform extremely well this year as energy prices have risen significantly off the back of what's happened in Europe. And the consequence of that is our investment universe has also underperformed. So the pink line here is the MSCI All-Country World Index, and the green line at the bottom shows the performance of the part of the market that we're investing in, which has underperformed during the year, largely because of those tilts in our area of focus. That's a reversal of a trend of outperformance that has lasted a number of years prior to this year. And then our performance this year has fluctuated. We were doing reasonably well against our investment opportunity set up until the last couple of months, and then we've underperformed our investment opportunity set in the last couple of months. So over the year, we're roughly in line with the part of the market that we focus on. It is the end, I think, or coming to the end of a period of underperformance of these kind of areas, and I'll talk to that in a minute. And yeah, we don't expect that trend to continue indefinitely, and in fact are quite sort of positive about the likelihood of that reversing over the next couple of years. So let me talk quickly about our broader thesis. Our firm was set up with a basic belief that the world has to change, that population growth and the desire for ongoing economic growth just simply weren't and still aren't consistent with a set of very evident environmental constraints and resource constraints that are only getting worse at the moment. And one way or another, whether you like it or not, things are going to have to change. And whether that happens, quickly and sensibly today or in a knee-jerk fashion in decades to come, the answer is still the same. Things are going to change. And we believe that as those changes take place, there'll be parts of the economy that are on the wrong side of that transition, and there'll be industries and technologies that contribute positively towards and benefit from that transition. And that's our area of focus. And the thesis is really supported by evidence of continued population growth, which is only going one way at the moment, increasingly unpleasant information about the way in which the climate is changing and some of the other environmental issues that we're facing, but also on the positive front, the way in which a very wide range of more sustainable, more efficient technologies are evolving and becoming more economically viable over time. And the consequence of that is that you're starting to see change accelerate across the economy. The easiest way to think about what the big changes are is to relate it to the big environmental problem, which is climate change. And if you look at what is causing greenhouse gas emissions or greenhouse gas concentrations to rise, it's all well known. We know what the source of the problem is. We know what needs to be done to mitigate emissions and reduce them over time. In just about every case, we know what the technology solutions are available to us to do that. And the question is really just how and when that takes place. And the answer to that is that it will take place in a way that we've seen repeated a couple of times over in the last 20 or 30 years, with government policy driving niche sustainable technologies to grow, and through that growth and capital investment and investment in research and development and the economies of scale and competition you get as a result, the cost of those technologies coming down to the point that they're economically viable and adopted on a widespread basis. And the good news is, in the last couple of years, you've seen a profound shift globally in attitudes towards climate change policy, and most of the world now has adopted or is in the process of adopting net zero carbon emission targets, which then flow through to inform much more specific mandates and policies and subsidies designed to shift different parts of the economies in the way that needs to happen. And as an example, in Europe, they have announced a suite of policies called Fit for 55, and shown on the slide here are some of the targets from that policy suite, which are very ambitious targets to help the EU achieve its 55% emission reduction target by 2030. And those kind of policies, again, well, you're starting to see them adopted in the US through its Inflation Reduction Act bill recently, and will continue to be adopted around the world. The challenge in all of this from an investment perspective is it's not necessarily the case that just because of these policies, any company involved in these areas will end up being a good investment. Typically what we see happen is when these kind of big policy announcements are made, it drives investment into small parts of the market that forces share prices up often in a pretty spectacular way, and that's something that we saw during 2020. But that does its job in terms of attracting other participants into the industries, companies to raise more capital, to invest that capital more heavily, to try and capture the benefits of the policy over time. Ultimately, what you generally see is that expectations of the original players achieving very high rates of growth for very long periods of time at very high rates of profitability because of the subsidies quickly fades as the realities of competition emerge. And we're in a period at the moment in which a lot of companies involved in sustainable technology that outperformed during 2020 have been underperforming very significantly as that proves to be the case. There are a lot of companies in areas like vehicle electrification and renewable energy that came to the market and listed during late 2020 and subsequently have very significantly underperformed. And really, from our perspective as the investors, we see the opportunity, really during this period that follows, when the policies that cause markets to react start to take effect 2 or 3 or 4 or 5 years later, and industries do really start to grow, and the winners start to emerge, and the companies with exposure to that growth start to demonstrate that they do have that exposure to growth, and their profits grow and they outperform. And so we're focused on finding good quality businesses that are exposed to these growth trends, but not buying them at points in time up here. One more sort of comment around what is going on in the world and what we think is likely to happen over coming years. We've seen some profound policy steps forward in the last couple of years, which have set the ground for higher rates of growth in many of the areas we focus on. But I wanted to point out that we're going to see that happen again and again and again over time. So this chart shows the global annual greenhouse gas emissions over time, and a series of projected pathways that are necessary in order to achieve a level of greenhouse gases in the emissions in the atmosphere that shouldn't see the world exceed 2 degrees warming. And there's 3 of them there, which simply illustrate that the longer you wait, the faster you have to reduce emissions, which is fairly logical. And there's a lot of work out there. It's all fairly consistent in terms of the required trajectories. The challenge we have at the moment is the policies that have been implemented, as aggressive and big as they are, really only put us on a trajectory that's up here somewhere. And the outcome of that is we are necessarily going to see another series of big step changes in government policy over time to help reduce this down. And secondarily, we're on a pathway that's nowhere near achieving controlling greenhouse gas emissions to a level that will keep global warming under control. And today's not the forum for discussing it, but there's a lot of reason to interpret consensus climate science as being quite conservative, because that's the only way it gets published. And there's an increasing amount of evidence that points to it being conservative, and some of the problems you're starting to see emerging around the world being a bit worse than people are projecting in that consensus. And yeah, inevitably it's likely that we're going to need very large scale carbon sequestration globally in order to deal with the problem. And that's something that is of interest to us longer term. Relatively nascent technology, but you should think high carbon pricing is coming. So the other big issue obviously is that energy security has come back to the forefront. It was a prominent topic 12 or 13 years ago. Hasn't been for a decade, but what's going on in Russia is clearly placing a very high imperative on changing the structure of energy systems worldwide. With that as background, I've got a whole raft of sort of examples here of things that we're invested in. I might flick through them quickly and then give the opportunity to come back and answer questions in areas that people are more interested in. One of the areas of the EU policy that is here is building renovation. So in terms of global emissions, buildings account for about 6% of direct emissions, typically burning fossil fuels for heating, but also a large portion of electricity, which is also used for heating and lighting and other things in buildings, and a big chunk of industrial emissions in terms of making things like cement and steel. And there is a huge job, if you want to decarbonise the economy, in decarbonising the real estate sector. Not just new buildings, which are a small proportion of the overall building stock, but on a retrofit basis, the entire global building stock, removing fossil fuel usage, electrifying things that can be electrified, improving building insulation and energy efficiency. And we have a number of stocks in the portfolio that are involved in areas such as that. Carlisle's been one of our larger and better performing positions over time. It's a US multi-industrial focused largely on building insulation. We have a position in the heating, ventilation and air conditioning space, which is starting to evolve technologically to also capture building management systems and energy management systems for buildings in an area that is outgrowing the sector. And similarly in Europe, we've got exposure to building insulation and energy efficient building materials through Saint-Gobain. Renewable energy, as I said, is an area that we don't have a lot of exposure in the fund at the moment, but is an area that we have invested in successfully over a long period of time. We haven't been invested over the last couple of years in a significant way because of valuation, but some areas are becoming increasingly interesting to us. Renewable energy continues to come down significantly and rapidly in cost over time. In Australia, solar and wind are now clearly the cheapest sources of new electricity generation, albeit intermittent generation. And as we seek to electrify the economy and decarbonise, we're going to see huge amounts more of wind and solar built globally. If you try and contextualise that, this year there'll be something between about 200 and 250 gigawatts of solar generating capacity deployed globally. That is about 5 times Australia's total generating capacity today. It's about a bit over 20% of US total generating capacity being deployed every year in solar. It's a huge amount. The wind market's not growing as quickly, but is an area we're focused on the research side at the moment, and I expect we'll have some investments in that space in coming months. It's been a far lower growth industry, much more difficult to deploy wind turbines, but the push for energy independence is going to see that change, and the policy support I talked about earlier is likely to see growth rates in wind start to rise in coming years. And at this point in time, many of the wind stocks are struggling with severe supply chain disruption and input cost pressures. Their profitability is at a cyclical low point, and the stocks haven't performed well because of that. And that presents us with an opportunity to buy what are fundamentally pretty good businesses in an industry that has improved over time, where growth expectations are likely to rise, and we think the stocks are likely to perform well. We have had a little bit of exposure in renewables in the last year or so, primarily through Turner Energy, which is a Greek wind developer that's performed well in a large part because of what's happened in Europe. Just quickly on energy, I can come back to it if people are interested. Nuclear is a very prominent topic today. We're not invested within the fund in nuclear, and that's it's an interesting discussion point. It will certainly have a role to play in energy systems going forward, but it's not an area that we think is particularly attractive from an investment perspective today. Vehicle electrification is obviously the other big trend at the moment. We are just at the beginning of a rapid adoption of electric vehicles globally. The constraint has really been the availability of electric vehicles and good quality electric vehicles. That's been resolved quite quickly. That's not difficult to understand, and stocks like Tesla are very expensive because of that. But we have sought exposure through companies that are providing components and systems that are more relevant to electric vehicles and where they're likely to see growth over time. So we've recently made an investment in Infineon, which is a European semiconductor company that is a leader in power semiconductors, which are very important in electric vehicles. It's growing around 10% per annum, and we think likely to surprise positively in terms of its profitability in coming years. We've got an investment in Hyundai Mavis, the main component and module and system supplier for the Hyundai and Kia motor group, and the sole supplier of electric drivetrain systems for their electric vehicle models. And that part of their business, which is about 15% of it at the moment, is growing at about 50 or 60% year on year, and likely to continue growing at that sort of rate as component availability in the semiconductor industry means companies like Hyundai and Kia can start manufacturing a lot more electric vehicles more quickly. And we've got an investment in TomTom, which some of you might know from its personal navigation devices, which are not a product that we think is their area of future success. In fact, they'll stop making them shortly. But it provides mapping technology, which is very important for electric vehicles to know about range and availability of charging infrastructure, but also for autonomous and active safety technologies, which are being embraced in electric vehicles as well. Within the transport space, we have a number of investments in the rail space. Wabtec is a leading provider of locomotive and rail equipment. It started producing electric locomotives, and we think that's going to be a significant profit driver for the business as the rail industry goes through another cycle of investment and stops buying pure diesel locomotives. We've got investments in the sustainable packaging space. That's something that's become increasingly prominent to consumers recently, and is starting to be regulated more heavily. If you go into the supermarket now, it's not hard to see that a lot of plastic packaging is being replaced by paper packaging. One of the leaders in that space is graphic packaging. You will have seen their products in places like Woolworths and Coles, with meat now on paperback trays, not polystyrene. It's a pretty boring, low-growth industry, pretty boring, low-growth company, generates excellent return on capital, and is starting to grow more quickly because of this trend, and we think that's likely, with regulatory support, to continue. Similarly, with an investment in SIG, which makes aseptic packaging, it's Tetra Pak's major competitor, and exposed to similar trends. Alternative protein is another area of interest to us, another good illustration of the way that we think about the world and how we invest. Plant-based protein is a part of the food market that is still relatively small and a niche, but is growing at a pretty sort of steady and interesting rate, so 15 or 20% per annum. That saw a big boost in 2020 when people started stocking up their freezers with anything they could get off a supermarket shelf, and when Beyond Meat, which is a prominent player in the space, listed in the US in 2020. But that reversed very quickly in 2021 when people stopped filling their refrigerators, and they'd gone and tried alternative protein products and decided they didn't need to stop eating meat. But we'll come back to a trend of growth that's very likely to be supported by government policies seeking to at least make consumers aware of the environmental footprint of meat products. But the players in that space to us aren't particularly attractive as investments in the downstream end. We think, like I showed in the curve earlier, the interest in the space has prompted a lot of competition to come in, and in order to grow, the pricing needs to come down, and that's not a great economic dynamic for the companies such as Beyond Meat. But we do have exposure through the largest ingredients company in the world, so if you want to turn pea or soy protein into something that looks like that, you need pretty good texturing and flavouring solutions, and that's what IFF does. And once again, it's a leader in its space. It's a large global company that's profitable and is likely to start growing more quickly than it has in previous years as that trend becomes more significant. In the interest of time, I won't go into more of these examples. Hopefully that's given you a sort of snapshot of what we do and how we do it. There's some interesting sort of information here about hydrogen, which is a topic we've talked about previously, and if you're interested, there's more on our website around that. And maybe I'll leave it with this, which is just a snapshot of where we see sort of areas that are likely to benefit from the way in which the world is evolving through this decade, and consequently are areas of focus for the fund, where we're trying to provide exposure, but exposure through companies that are sound businesses and likely to outperform. Any questions?
Is NANOC an acronym?
NANOC's an Inuit word that means polar bear. Hence the logo. It's very hard to find a name for a funds management business that hasn't been used somewhere in the world previously. That's what we ended up with.
And would you be interested in that new solar thing that Queensland government's designed? They're looking for private investors in that as well, like around the fire fund or whatever it's
So our fund invests only in listed companies, so we won't participate in private funding of large projects. But certainly, if you look at projects like that, some of the companies that sponsor them, and certainly the equipment providers, are the kind of companies that we focus on. And it's interesting. I mean, I think it's a good example of the way in which policy changes in an aggressive and stepwise fashion. The announcements last week around Queensland's medium-term energy planning are pretty profound. I mean, 80% renewables by 2035, and some of the infrastructure deployment they're talking about is very significant change from where we are today.
Thank you.
Talk's cheap. Talk is cheap.
I would just say I think we're a long way yet from the wind power and all the things that are happening. And it's a little bit like, let's keep what's keeping generating our power and all the things that we've become used to before we move to the next stage. You know, you can't, like we're doing, cutting everything down and then expecting that all this renewable is going to sustain a city or a country. Germany, I noticed you had a thing up there, Germany have gone back to opening up their cold factories and so forth. So I'm sort of not yet convinced that in time it'll happen, certainly, but I don't think we've got enough yet, technological information that's going to be beneficial at this time. I heard just recently that if you had an electric car, the battery lasts for about 8 years. Now this is good for a portfolio or an investment, but the battery costs $47,000. So you wouldn't want to buy a second-hand battery powered car. Would be me at this point. I'm not saying it won't happen. I'm not saying that we're not moving to the next thing, but I don't think we should be shutting down our coal and our gases until the sustainable is up and running properly.
Yeah, I don't think there's a high risk of that. There's one thing governments are very sensitive about, and that's keeping the lights on. And the politicians won't.
Nobody will speak up.
They won't do it. But so I don't think you should be too concerned about the lights going out. The reality is that we do have all the technology we need today to operate grids in a reliable and sustainable manner without fossil fuels. But you can't just make it happen overnight. It's a huge amount of infrastructure. It's an enormous amount of capital investment to make that transition. But yeah, as I sort of tried to point out earlier on without being over dramatic about it, it needs to start happening at a really rapid rate today, or environmental problems are going to get apocalyptic within my lifetime, if not my children's lifetime. And the geopolitical consequences of China running out of food and water and things like that happening are unconscionably bad. And I wouldn't be too sort of downbeat about the prospects of existing technology providing the solution. Solar energy is extraordinarily cheap compared to even the operating costs of fossil fuel plants that are already up and running today in most parts of the world. The problem is not that the technology doesn't work. It's not that the technology is too expensive. It's not. It's very cheap. It's dealing with this intermittency problem, and that is a challenge. But the technologies are there to deal with that. And it's not a single solution. There's not a silver bullet to all of this. We're moving from an antiquated. It's a bit like telephony or computers. We're moving from an antiquated system of centralised mainframes to a system of networked devices, and the energy system's much the same. We're going from centralised power stations, which are expensive and polluting, with a very expensive distribution system, to a much more dynamic network of resources, different resources. And the technologies all exist to make that happen. The challenge is really regulatory and economic around how you do that today. And I'm very confident that over the next decade you'll see progress on the regulatory side that will enable us to have largely renewables supplied grids that provide a stable and reliable power system. We'll need some storage, we'll need some intermittent dispatchable generation, which will probably need carbon capture and storage or hydrogen. But it's all their technology that's available today. It's just how do you get that investment to happen. And on the EV side of things, I mean, I do take point with you. I'm sure there are vehicles out there where it costs $47,000 to replace the battery, but you can buy a new electric vehicle for $47,000, and there's no way the battery in that thing costs $47,000. It's more like $7,000 or $8,000 for an average car now, and the rate at which battery technology is improving and prices are coming down. Companies like Tesla are starting to warrant batteries for 1 million miles. And the cars are going to run out before the batteries do. So it's not an unsolvable problem.
I have one question about recycling and processing technology. Is it likely that you'll be looking into recycling companies that deal with the waste from solar and energy storage or batteries?
Yes, yeah. There aren't many.
Because that's going to be
Yeah.
a real problem in the next few decades.
How long does a solar panel last?
25 years.
No, they're warranted for 25 years. They'll keep working for 50 or 60 or 70 years unless they get damaged.
About wind turbines.
Yep, yeah, no, and look, there's a much broader question about waste management and recycling in the economy. There's a lot of talk about electric vehicle batteries and solar panels, but that is largely naysayers trying to create noise around the issue. Solar panels not particularly more difficult to deal with recycling-wise than a flat panel television. There's billions of these things around the world. No one's been talking about the recycling problem of them, and they do get broken and thrown out in less than 25 years. But yeah, that's an area of interest to us. There's actually been a couple of automotive battery recycling businesses listed in Korea in the last few months, and those are things that we're interested in. But those are very nascent businesses. The volume in that industry really isn't there for companies to be operating at scale and making profit, and we're not going to sort of pay up with our investors' money to try and just have that exposure for the sake of it. Yeah. And look, I mean, maybe I should make a point here. Whilst I express some views that might be different to other people's in the room and some conviction about the way the world's headed or needs to go, at the end of the day, we are primarily just investors, and our primary goal is not to deploy your hard-earned savings into things that are going to save the world. Our number one goal is to generate good investment returns for our clients. And when we are sort of struck with a choice between investing in company A and company B, the decision is entirely around investment merit and the prospects of generating investment return, not about is company A going to deliver, better environmental outcomes than company B. Because of where we focus, everything's generally on the right side of the ledger, and our focus is on trying to deliver good investment returns, not save the world at your expense.
I might just leave it there. Thanks, Tom. We've just run a little bit over time, so I'm conscious that people need to get back to work or get back to retirement. But Tom and Andrew might stick around for a little while longer, so if you've got any more questions, please feel free.